Welcome back to the deep dive. If you're here hoping to cut through all the jargon and big financial reports and get straight to what really matters, well, you're definitely in the right place. Today, we're diving deep, really deep, into a, let's say, fascinating case study in the Turkish market. 1000 Yatırımlar Holdingas.
That's right. And, for anyone tracking those high-growth sectors, think micromobility, EV charging, big energy projects, this holding company is pretty central. It helps understand where capital's flowing in that region.
Exactly.
So our mission today really is to carefully pick apart their financial performance and their strategic moves for the first 9 months of 2025. So that's January 1st right through to September 30th.
Yeah, and we're not just, reading numbers off a page here. We're interpreting them. We've got the official activity report, the financial statements, all prepared under TFRS. And, this is crucial, using those complex inflation accounting rules, TMS 29. We really need to slice through that technical stuff to give you, the listener, the individual investor, a crystal clear picture of what this company's actually worth and, well, how it's making its money.
And understanding that inflation accounting, TMS 29, it's not optional here. It's fundamental. It's the absolute bedrock of our analysis. It really dictates how you capture real value increases when inflation is high. It changes everything about how you look at profitability.
Absolutely. We're cutting through all that complexity to figure out exactly what they own, how they're managing it, and maybe most importantly, the real story behind that multi-billion lira profit turnaround they reported. And look, if this kind of detailed forensic financial deep dive helps you make better investment decisions, if it clarifies these complex reports for you, maybe do us a small favor.
Please do.
Hit that subscribe button, like this analysis, maybe share it with someone else who, needs this level of insight.
Yeah, we'd really appreciate that support. This is complex stuff, and the aim is always to make sure you walk away feeling properly informed.
Okay, let's unpack this. Right, let's start with the basics. Who exactly is 1000 Yatırımlar Holding AŞ? Because they aren't your typical company running day-to-day operations, are they?
No, not in the traditional sense. They're really an investment house. Think of them as a capital structure first and foremost.
Okay.
They were set up pretty recently, actually, March 28th, 2022, based in Ümraniye, Istanbul. But their legal setup, their structure, that defines everything we're about to talk about.
So what's their core activity then?
It's capital management. Pure and simple. They exist to take stakes in other companies, established ones or new ones, help organize financing for them, actively manage those investments.
And, I guess, protect the whole portfolio from economic ups and downs.
Exactly. Managing investments, ensuring security against volatility, that's the core mission.
So their main product, if you like, isn't something physical. It's maximizing return on investment through, well, financial strategy and oversight, like a specialized VC fund, but publicly listed.
That's a really good analogy, actually. Perfect one. And their investment strategy clearly shows that financial focus. It's really zeroed in on high-growth sectors, places where you see rapid scaling, technological disruption.
Right, like transportation, leasing.
Integration, software, Islam, and energy. They're basically tracking these big global shifts and making strategic bets in those areas.
And there's a key phrase in their own documents, isn't there? Something about maximizing value through successful exits.
Yes, absolutely. Finding the right model, the right time to sell off a profitable venture, that's critical to understand. Their model inherently favors capital gains, maybe more than long-term operational stability of any single unit.
Which is a really important distinction for you, the individual investor. You're putting money into a company whose success hinges on smart portfolio management, asset appreciation, not necessarily the slow, steady growth of one specific business.
Correct. It's a different risk profile. Higher risk, potentially higher reward, all tied to spotting and scaling up these disruptive companies effectively. Hashtag tag 1.2 ownership and capital structure.
Okay, so who's actually pulling the strings here? Let's look under the hood at the ownership. It seems quite concentrated, right?
It is. You see 5 main individual shareholders listed. Usame Erdoğan, Mustafa Simbirpınar, Kadir Ken Abdik, Hüseyin Ardan Küçük, and Haris Poçata.
Right.
They collectively hold significant sway. And then there's Lydia Yatırım holding A, which has nearly a 9% stake. So yeah, control is pretty tightly held within that founding group.
And that control is baked into the share structure itself, isn't it? This split between Group A and Group B shares. Can you break that down for us?
Sure. It's a classic governance setup, really. You have Group A shares, about 219.6 million of them, These carry special privileges. They get to nominate board members. They hold specific voting rights.
Yeah.
Then you have the Group B shares. That's the vast majority, 1.7 billion shares, but they don't have those special privileges.
So this ensures the founders keep control, even if the total number of shares goes way up, especially thinking about that huge capital increase recently.
Precisely. It locks in stable governance and direction, regardless of future share expansion.
Okay, let's talk about that expansion. The massive financial headline from Q3 2025, the Bedelse Sermaye Artırma, the free share capital increase. It was enormous, right? Like 2,645%.
Monumental is the word. I mean, the capital base went from 47 million Turkish lira all the way up to 1.29 billion lira.
Wow.
Now, if you're not familiar with Turkish financial rules, you might think, wow, they raised a ton of cash. But actually, the opposite is true. This was purely technical, an internal accounting move.
Okay, hold on. What does that mean for the listener? If they didn't sell new shares for cash, where did that extra, 1.24 billion lira actually come from?
It came entirely from internal reserves, money that was already sitting on their balance sheet in different accounts.
Like what?
Well, they pulled about 31.3 million TL from inflation adjustment differences. That's a direct result of TMS 29. Then a huge chunk, 1.1 billion TL, came from share issue premiums. That's basically cash they received from past share sales that was above the nominal value.
Right.
And finally, about 106.9 million TL came from retained earnings, so past profits they'd kept in the company.
So they're just relabeling money they already had, moving it from reserves to the official share capital line. Why bother? Why go through all that for a technical change?
It sounds technical, but there are strategic reasons. First, it makes the equity position look much stronger on paper. That can help with things like credit ratings, demonstrating financial solidity, especially when you pair it with the big net profit they reported.
Right. Optics matter.
They do. Second, having a larger registered capital base can sometimes make certain future regulatory steps easier or meet capital requirements for subsidiaries. It basically converts these, let's say, softer reserve accounts into hard official share capital. Shows long-term commitment. Think of it as a balance sheet cleanup and strengthening exercise. It was approved back in May, registered in September 2025. Hashtag 1.3 management and personnel.
All right, let's shift to the people actually running this operation. The board has 8 members. Seems pretty standard, 5 non-independent, 3 independent.
Yeah, and those 3 independent members are key for governance. Their names are Emin Kanbalat, Eyüp Şişman, and Osman Dinsbaş.
And why are they so important?
Well, they sit on the mandatory committees, audit, early risk detection, corporate governance. Their job essentially is to provide oversight, make sure the company's aggressive investment strategies are managed for risk, and that everything complies with SPK rules. They serve 3-year terms, which gives some stability.
Got it. And the general manager, the Genel Müdür, is Kadir Khan Abdik, who's also on the board as a non-independent member.
Correct.
Now, a standard governance check these days is gender representation on the board. What's the situation here?
It's present but limited. There is 1 woman out of the 8 board members. That's 12.5%.
And that's Emin Kanbalat.
Yes, Emin Kanbalat, who serves in that critical independent board member role. It's definitely an area investors are watching globally, just as a standard metric.
Okay. What about the overall workforce? Any trends there?
A couple of interesting points. The staff at the holding company itself actually grew a bit, from 37 people at the end of 2024 up to 44 by Q3 2025.
More managers, maybe?
Seems likely, yeah. More internal oversight capacity needed as the portfolio grows. But interestingly, the total staff across all the financial investments, the subsidiaries, actually decreased slightly. Went from 361 down to 317.
Huh. Why would that be?
Could be a couple of things. Maybe reflects the Bin IPO success. The holding stepped back a bit operationally there, letting the public company management take over more. Or just general efficiency gains in the subsidiaries, perhaps.
Let's talk money. Executive pay. What are the top folks earning? Because it looks like it jumped significantly.
It did. The total compensation, that's salary, bonuses, the works, Ukroprim, Okromia for top management, hit 16.3 million TL for the first 9 months of 2025.
And importantly, these are inflation-adjusted numbers, right? Thanks to TMS 29.
Critically important, yes. These are real terms figures. The comparable number for the same period in 2024 was 10.0 million TL.
So that's a 63% increase in real terms.
Yes, a significant jump.
Okay, I have to push on this a bit. We're going to talk about the huge profit, but as you said, it's mostly from asset valuation increases, not really operations. Is a 63% real pay hike for management justified when the profit driver is essentially a mark-to-market gain on assets they already held?
That's a perfectly fair question for an investor to ask. Management's argument, undoubtedly, would be that the massive asset value increase, that 5.2 billion TL profit driver we'll get into, is a direct result of their strategy, their risk-taking, the timing of the Binbin IPO, the growth they fostered in MetaMobilite, and so on.
So the pay is linked to perceived value creation, even if it's unrealized gains.
Pretty much. The compensation framework they approved back in June 2025 kind of reflects this. Independent board members get twice the net minimum wage monthly, while other board members get 10 times the net minimum wage, monthly and net. Sets a clear premium on the executive roles tied to delivering that value.
Right. High stakes, high rewards for asset management. But the governance structure seems solid, with the committees staffed by independents.
Yes, the framework is there. Audit, risk, corporate governance, all functioning with independent oversight. That provides some comfort on compliance, even if the strategy itself is, let's say, aggressive.
Okay, we've got the corporate structure, the governance, the people. Here's where it gets really interesting. Let's look at the engines, the actual companies in the portfolio that are generating all this value. The strategy seems built on three main pillars, right? Micromobility, charging, software.
Exactly. And the absolute cornerstone, the asset responsible for the lion's share of the holdings valuation, is Binulishim ve Akuli Shehir Teknolojileri AES. Everyone knows them as Binbin.
Right, the e-scooter guys.
The holding still has a hefty 75% stake, even after the IPO back in October 2024.
And they're big, operating in 16 cities, 5 countries. You mentioned they were the first Turkish micromobility company to go international. That's quite something.
It really is. Speaks volumes about their ambition and execution. And operationally, they hit some nice non-financial milestones in Q3 2025, too. Got the Great Place to Work certification, good for hiring. Launched in Tirana, Albania, continuing that expansion. And they inked a sustainability deal with Neocycle for recycling. Important for their image.
Okay, but critically, what about their financial health? There was an external validation, wasn't there? A credit rating.
Yes, huge news. DRC, the rating agency, gave them a long-term rating of TRA and short-term TRA1 with a stable outlook.
Now, for you, the investor, what does a high credit rating like TRAA on Binbin actually mean for the holding company?
It's excellent news, because Binbin is by far the biggest asset on the holdings books. This high rating suggests Binbin itself is financially robust, lower default risk, probably has strong cash flows, more stable.
Right.
And since the holding value's Binbin at market price, we'll get to the 15 billion TL figure later, this strong credit quality helps justify that valuation. It should reduce some investor anxiety about volatility. Remember, that IPO was oversubscribed 1.4 times. Huge demand, 1.56 billion TL raised. The market clearly likes this asset.
Okay, moving to Pillar 2, energy. Specifically, MetaMobilate Energy AE, which they brand as Q-Charge. The holding had a 92% stake before something happened recently.
Correct. Their goal is clear, become a leader in Turkey's EV charging market.
And their strategy seems smart partnerships, like the one with Trugo, TOG's charging network.
Exactly. Opening up Q charge stations to Trugo users, that immediately expands their reach, validates their tech. It's a clever move. They also signed an OU, a Memorandum of Understanding, with a major Chinese energy tech firm.
Oh, what for?
Exploring cooperation on EV charging operations, yes, but also, significantly, on battery energy storage systems, EES.
So not just charging cars, but grid-scale batteries, too.
Potentially, yes. It shows they're thinking bigger about grid stability, energy storage markets. It positions Q-Charge in a much broader energy context.
But the really big news for Q-Charge was the external investment, right? Terry Yatırım Technology Holding TL.
Yes, this was a major development. Teal agreed to invest $7 million for a 20% stake in MetaMobilite.
Wow, $7 million. What does that signal?
It's a huge vote of confidence. First, it secures vital capital for Q-Charge's expansion plans. Specifically, they mentioned installing their own solar power, GES, to power the stations. That's smart. Second, and just as important, it sets a valuation benchmark for this unlisted asset.
How so?
Well, if 20% is worth $7 million, that implies a pre-money valuation of around $28 million for Q-Charge. It validates the holding's internal valuation work and brings in cash without the holding having to put in more of its own capital or dilute itself too much. Post-investment, the holding stake drops to roughly 80%.
Okay, that makes sense.
Yeah.
And the third core piece, software, Algorithma Dönenim ve yazılım işi, fully owned.
Right. This started life as basically the internal IT department for the group, building their software, handling hardware needs.
But it's changing.
It is.
Yeah.
Smart pivot. They're now taking those capabilities and developing white label solutions to sell externally, both in Turkey and internationally.
Aiming for what kind of products?
High margin tech. They specifically mentioned SaaS, software as a service solutions in cybersecurity, fintech, and AI.
And they explicitly mentioned aiming for foreign currency income. Döviz getirici faaliyetler. That sounds important for Turkish investors.
Hugely important. Generating income in dollars or euros acts as a natural hedge against lira volatility. If Algorithma can successfully sell high-value software globally, it diversifies the holdings income and makes the overall balance sheet much more resilient to currency risk. That's a major plus in this region.
I'm serious about this.
Seems so. Just after this reporting period ended, post-September 30th, the holding announced they'd increased Algorithma's capital significantly, up to 200 million TL. That signals a real commitment to this external market push. Hashtag TAC 2.2, emerging sectors, and strategic moves.
Okay, so beyond that core tech trio, 1,000 Yatırımlar isn't standing still. They're pushing into new areas too. Let's look at Altay Yenilenebilir Enerji Üretim ve Depolama İş. Altay Energy. This is their renewables play, aiming for carbon neutrality for the group.
That's the stated goal, yes. Altay Energy is definitely a longer-term strategy, focusing on renewable generation and storage. And the scale here is significant. They reported investing 26.9 million TL just in land and real estate needed for the power plants.
But there was an even bigger number linked to property, wasn't there? With Emlak Konut.
Yes, a massive 507.4 million TL sales promise contract with Emlak Konut GYO. This suggests they are acquiring substantial assets, likely land or development rights, needed to build out these large energy projects.
And the projects themselves, what are we talking about?
Well, there are two smaller solar power plants, GES projects, totaling about 2.1 megawatts in Şanlıurfa and Vanay. Those were actually targeted to be operational by the end of Q3 2025.
Okay, so maybe already running.
Potentially, or very close. But then there are much larger projects planned. 14.9 megawatts total, split between Antalya and Nevşehir. Those are targeted for Q1 2026 operation.
Right, so those are still quite a way off. What should investors watch here?
Execution speed. These are big infrastructure builds. Any delays in getting those larger 14.9 milliW plants built and connected to the grid by early 2026 would be a concern. The valuation of Altay Energy really depends on these projects coming online and generating revenue as planned. It's a key non-financial metric to track.
Okay. Next up, FinTech. 1,000 Udemy Hizmetleri ve Elektronik Para. 1,000 pay. The big news here was the license, right?
Absolutely critical step. They got their electronic money institution license from the Turkish Central Bank, the TCMB, back in June 2025.
And what does that license let them do?
It opens the door to a whole range of potentially high-margin financial services. Digital wallets, prepaid cards, mobile payments, money transfers, even virtual and physical point-of-sale systems.
I can see the synergy already.
Oh, definitely. Think about it. 1,000 Pay could integrate directly into the BinBin app for scooter payments, handle charging fees for Q-Charge, provide payment infrastructure for Algorithma's SaaS products. It creates this powerful closed-loop ecosystem within the group. Keeps customers sticky, captures more value.
Makes sense. We also saw them move into taxis. Istanbul Digital Taxi, Uygulamaları, rebranded as BinBin Taxi.
Yeah, fully owned. They already had the necessary license, the Electronic Transportation Management License, which is a barrier to entry. This just brings the taxi hailing service firmly under the main BinBin Mobility brand. It suggests they see value in combining traditional transport with their tech platform.
Okay, and finally, this one seems a bit odd. The 4B Mühendislik Age pivot. They were going to merge it with Meta Mobility, the charging company, but then they didn't.
Right. That plan was canceled in August 2025. The report cites conjunctural changes, basically, changing circumstances.
So what do they do with 4B instead?
This is the surprising part. They pivoted completely. They used 4B Mühendislik to acquire 50% stakes in two completely different companies. Yağmur Süt, a dairy company, and Aksigüda, a wholesale food business.
Wait, dairy and wholesale food, what's a tech and energy holding doing, buying into that? The total cost was 142 million TL.
Exactly. It's a textbook example of management being agile, maybe opportunistic, but it definitely stands out from the core strategy. It seems the Meta Mobilite merger hit a snag, maybe valuation issues, maybe regulatory hurdles, we don't know for sure.
So rather than let 4B sit idle,
They deployed its capital, that 142 million TL, into a totally different sector where they presumably saw a quick opportunity.
Just diversification.
Or something else. Could be partly diversification, but it feels more like a rapid value or cash flow play. Food and wholesale, especially staple commodities like berry, can offer stable, potentially quick cash generation and might act as an inflation hedge.
Interesting.
It really shows that the holding sees its core skill as capital allocation itself. If they spot what they think is a good 142 million TL opportunity, even outside their main tech energy focus, they seem willing to take it.
Yeah.
Okay. So we've seen the strategy, the assets. If we connect this to the bigger picture, now we dig into the actual numbers. And just a reminder, the lens here is absolutely critical.
Right. Inflation accounting.
Exactly. Inflation muhasabesi. All the figures we're discussing are inflation adjusted according to TMS 29. They reflect purchasing power as of September 30, 2025.
Let's pause on TMS 29 again. Why is it so important for the individual investor to really get this?
Because in a high inflation economy like Turkey's been, traditional accounting just doesn't work well. It misrepresents real performance badly. TMS 29 forces companies to restate things like fixed assets, inventory, equity, using a price index.
So it makes comparisons fair.
Precisely. It ensures that the 2025 results we're looking at are compared against 2024 numbers expressed in the same purchasing power. Without it, that huge profit we're about to discuss would look even bigger, but it would be inflated by just, well, inflation. Meaningless for assessing real value creation. Hashtag 3.1 Hasalato and investment income. The critical distinction.
Okay, got it. So let's start right at the top line of the income statement. Gross revenue, Hasalat. The report shows zero. Zero TL for the first 9 months of 2025 and zero for the same period in 2024. That seems impossible. How does a multi-billion lira company have zero revenue?
Okay, this is probably the single most crucial accounting point to understand about 1,000 Yatırımlar. It's what makes them different from a regular operating company.
Go on.
Before 2025, sometimes, increases in the value of their financial investments might have been booked under Hasalat. But there was a change, a clarification in how TFRS 10 applies to investment companies like this. Now, those gains from their long-term investments are correctly reported elsewhere.
Where?
Under a different line item, investment activities income, or Yatırım Faaliyetlerinin Gelirler.
So if you, the investor, just glance at the Hasalat line, you'd think the company did absolutely nothing.
Exactly. You'd be completely misled. You have to basically ignore Hasalat for this type of company and go straight to that investment income line. That's where the real story of their performance, their ability to grow asset value is told.
Okay, so let's look there. What was the investment activities income?
It was huge. For JANSEP 2025, it totaled 5.337 billion TL.
5.3 billion lira.
That's the engine of their profitability. And drilling down, 5.242 billion TL of that came specifically from the increase in the value of their long-term financial investments.
Mostly Binbin's stock price going up.
Primarily, yes. As Binbin is listed, its value is marked to market. So as its stock price appreciated during those 9 months, that gain flowed directly through to the holdings income statement under this line.
Which means fundamentally their profitability relies almost entirely on market sentiment and appraisal games, not selling things day to day. That feels high stakes.
It absolutely is. The profits reflect real asset appreciation, which is good quality in that sense. But yes, they are incredibly sensitive to market swings. If Binbin's stock had tanked in Q3, that 5.2 billion TL gain could easily have been a massive loss instead. That volatility is just inherent in this pure investment holding model. Hashtag 3.2 core operational performance, İsas Faaliyet Kari.
Okay, so massive gains from investments. But what about the cost of running the holding company itself? Managing the portfolio, paying salaries, rent, etc. We need to look at the İsas Faaliyet Kari, the core operating profit or loss.
Right, and as you'd expect for a holding company structure, it shows a loss. But the key here is the trends. The operating loss for JANSEP 2025 was significantly lower than before. It came in at 90.9 million TL.
Okay, a 90 million lira loss. How does that compare to 2024?
Much better. The loss for the same period in 2024 was 264.1 million TL.
Wow, so they cut the operating loss by, what is that, almost two-thirds?
Yeah.
65% in real inflation-adjusted terms.
Exactly. A really significant improvement in controlling the holding's own running costs.
Is that just belt tightening, or could some of it be how costs are allocated under inflation accounting?
It's probably a mix of both. TMS 29 does affect how things are stated, but a reduction this large strongly suggests genuine cost control measures were effective. Look at general management expenses specifically. They dropped from 286.3 million TL in the 2024 period down to 156.3 million TL in 2025. That's a massive cut, and remember, it's in real terms.
Where did the savings come from? What are the big chunks of that 156 million?
The two biggest components were software expenses at 65.7 million TL, understandable given Algorithma and their tech focus, and personnel expenses at 62.1 million TL. Consulting fees were much smaller, around 6.8 million TL.
Interesting. Personnel costs are still significant, even with the overall cut. And didn't you say the holdings' own staff numbers went up slightly?
They did, from 37 to 44. So the fact they absorbed that increase in headcount and still managed to slash total overhead so dramatically suggests either very aggressive cost-cutting elsewhere, or maybe some operating costs are now being pushed down and absorbed more directly by the subsidiary companies. Hashtag 3.3 net profit and earnings per share.
Okay, the moment of truth then. You take the massive investment gains, subtract the reduced operating costs, factor in any financing costs like interest on that new debt. What's the final bottom line? The Adonib Kyocera net period profit or loss.
The result is genuinely dramatic, a complete turnaround. For Yansep 2025, 1,000 Yatserim reported a net profit of 3.256 billion TL.
3.25 billion lira profit. And what was it in 2024?
A net loss, a significant one actually, 1.896 billion TL for the same period in 2024.
So that's a swing from nearly a 2 billion loss to over a 3 billion profit, over 5 billion lira difference.
Exactly. It confirms that those huge financial valuation gains completely swamped all the operational and financing costs. It really validates the high-risk, high-reward investment strategy, at least for this period.
Okay, now for the metric that matters most to individual shareholders. Earnings per share, ECS, or paid Bushina Kazanj. We absolutely have to factor in that huge 2,645% bonus share issue, right? That dilutes things massively.
Critically important. That structural change, the Bedelsis Sermaya Arterima, fundamentally changed the number of shares outstanding. So to compare 2025 EPS to 2024 EPS in any meaningful way, you must adjust the 2024 share count as if that bonus issue had already happened back then.
Right. Otherwise, the 2025 profit would look artificially spread thin over way more shares.
Precisely. It wouldn't be an apples-to-apples comparison of shareholder value creation.
So doing that adjustment using a consistent share base, which is the only valid way, what does the EPS look like?
For 2025, the EPS comes out as a strong positive, 2.52 TL per share.
2 lira, 52 kurush per share. And the adjusted 2024 figure?
That was a loss of 1.47 TL per share.
Okay, so even after that massive expansion in the number of shares from the bonus issue, they still managed to generate 2.52 TL in profit per share.
Yes. It really underscores the sheer scale of that 3.25 billion TL net profit. It means the total value created by the holding was so large that it significantly outweighed even that massive dilution effect from the bonus issue.
Right. We've confirmed the profitability. Huge turnaround. But profit is one thing. The underlying strength of the balance sheet is another. So what does this all mean? How solid is this company financially? How much debt are they carrying? What are the risks lurking in the details? Hashtag 4.1 assets and financial investments.
Well, the balance sheet itself tells a story of significant growth. Total assets grew substantially. They went from 15.13 billion TL at the end of 2024 up to a really impressive 20.24 billion TL by September 30, 2025.
So that's about 5.1 billion lira growth in assets in 9 months. Where did most of that growth happen?
Almost entirely in non-current assets, Duran Varlikler. That's the long-term stuff.
Okay, how much did non-current assets increase?
They jumped from 13.16 billion TL to 18.22 billion TL. And this is where, as you said, the financial investments live. It means basically 90% of the holding's entire asset base is tied up in these long-term investments and subsidiaries.
Which perfectly reflects their business model.
Exactly. The total value booked for long-term financial investments is 18.19 billion TL. Now, how they arrive at that number is crucial for you, the investor, to understand. This is where TFRS 10, the investment company exemption, really matters.
Okay, remind us what TFRS 10 lets them do.
TFRS 10 allows a company that qualifies as an investment entity, like 1,000 Yatserim does, to not consolidate its subsidiaries line by line in its own accounts. Instead, it can measure those investments at fair value through profit or losses, meaning the changes in the estimated value of those subsidiaries directly hit the holding's profit or loss each period. It makes sense for an investment house whose goal is often to buy, grow, and eventually sell these stakes, rather than run them forever like integrated divisions.
And how do they determine that fair value? Does it differ for listed versus unlisted companies?
Yes, fundamentally. Let's break down that 18.19 billion TL total.
Yeah.
The biggest piece, by far, is their stake in Binbin. Because Binbin is listed on the Borsa Istanbul, its value is relatively straightforward to determine. It's valued at its market price, Borsa Raichi. As of September 30th, that valued their Binbin stake at 15.000 billion TL.
So 15 billion of the 18 billion total is just the market value of their Binbin shares on that specific day.
Correct. And the fluctuations in that market price during the Jan-Sep period are what drove most of that 5.2 billion TL investment gain we talked about earlier.
Which means, theoretically, if Binbin's stock price had a bad day, say, dropped 10% on September 30th, the holdings reported assets and net profit for the quarter would have taken a huge immediate hit.
Absolutely. That's the direct link the sensitivity investors need to grasp. The value is real-time but volatile.
Okay, so that's 15 billion. What about the other 3.19 billion TL in long-term investments? That must be the unlisted companies like MetaMobilite, Algorithma, Alte Energy.
Precisely. And valuing those is much more complex. Since there's no daily market price, the holding relies on valuations performed by an independent SPK-authorized valuation firm.
Using what methods?
They mention using standard techniques like discounted cash flow, DCF, or IGRINE in Turkish, and net asset value, NAV methods.
So those valuations are less volatile day-to-day than Binbin stock price.
Generally, yes, they're updated periodically, maybe quarterly or semi-annually. But their accuracy depends heavily on the assumptions baked into those models, things like projected future cash flows, growth rates, the discount rate used. Small changes in assumptions can lead to big changes in valuation for these unlisted assets. Hashtag 4.2 equity, debt, and liquidity.
Okay, let's flip to the other side of the balance sheet. Liabilities and equity. How did the equity section, as Kanaklar, look after booking that huge profit and doing the capital restructure?
Equity looks incredibly strong. It rose from 11.53 billion TL at the end of 2024 to a really commanding 14.79 billion TL by September 30th.
Driven by?
Two main things. That massive 3.25 billion TL net profit flowing directly into retained earnings, and the technical effect of the Betelgeuse Sermaye Artırma, which significantly increased the paid-in capital line. This huge equity base gives them a very strong foundation, a big buffer against future risks or for funding growth.
Did shareholders see any of that profit? Was there a dividend? What's the policy?
No dividend payout from 2024 profits. The company's dividend policy, approved in June 2025, specifically stated that the distributable profit from the previous year would be retained within the company.
Why?
The rationale is clear. Prioritize strengthening the equity base further and reinvesting capital into the growth of the subsidiaries, funding those big GES projects at Alte Energy, helping Q-Charge expand with the T-Shell investment, supporting Algorithma's push. It's a classic growth company strategy. Reinvest everything, reward shareholders later through capital appreciation, hopefully.
Right. Okay, now let's talk debt. Holding companies often use leverage. Did Unthousand Yatırımlar take on more debt?
Oh, yes. Total financial liabilities, that's short and long-term bank loans, mainly saw a very significant increase. They jumped to 196.9 million TL by September 2025.
Up from what?
Up from practically nothing, just 6.8 million TL at the end of 2024, which the notes say was mostly just credit card balances. So they definitely tapped the debt markets this year.
And the cost of that debt, what was the interest rate?
This is a crucial detail, often buried in the notes. The report states the effective interest rate on this new borrowing was high, around 51%.
51%. That seems astronomical even in a high inflation environment. Why take on debt that expensive?
It signals a couple of things. One, strategic urgency. They clearly wanted capital now to fund projects they believe will generate returns far exceeding that 51% cost. Waiting for potentially cheaper but slower financing wasn't an option, it seems. Two, it signals management's confidence, perhaps overconfidence. Time will tell in the profitability of the underlying investments, like Alte's solar plants or Q-Charge's market grab. They're making a big bet that the returns will justify the high financing cost.
It's aggressive, but despite taking on nearly 200 million in new expensive debt, you said their liquidity position looked surprisingly good.
Very good, actually. Their cash and cash equivalents balance shot up dramatically. It reached 376.2 million TL compared to just 62.5 million TL at the end of 2024.
So if you calculate net debt, which is total debt minus cash, they have way more cash than debt.
Exactly. Roughly 197 million TL in debt versus 376 million TL in cash. From a pure liquidity standpoint, the risk seems very low right now. They have ample cash to cover obligations.
And did the cash flow from operations support this? Did they actually generate cash from running the business, or was the cash increase just from borrowing?
The operational cash flow picture improved dramatically, too. Ashlet me Falietlerinen Nakit Akusha, or cash flow from operating activities, turned positive. It was 159.7 million TL for the 9 months, compared to a significant negative flow of 463.5 million TL in the same period of 2024.
That's a huge turnaround in operating cash flow as well. Why the big swing?
It's partly driven by adjustments made to the massive net profit figure, adding back non-cash items like depreciation or valuation gains. But the report also mentions favorable changes in working capital. Essentially, it means the holding itself stopped burning cash just to run its own operations. It adds a layer of underlying financial health, which is reassuring beyond just the big asset value gains. Hashtag 4.3 related party balances and risks.
Okay, this is often where the skeletons hide in holding companies. Related party transactions, the internal dealings between the parent and its subsidiaries. The numbers here look very large.
They are substantial, and this is definitely the key area of concentration risk we need to unpack. Let's start with related party receivables, a la Kakler. This is money owed to the holding company by its subsidiaries.
How much are we talking?
It increased significantly. By September 30th, 2025, subsidiaries owed the holding 1.13 billion TL. That's up from 773 million TL at the end of 2024.
A billion lira in internal loans. Is that concentrated in specific subsidiaries?
Highly concentrated. The notes show Metamobilite, Q-Charge, owes the lion's share, about 790 million TL, and Alte Energy, the renewables arm, owes another 241 million TL.
So basically, the holding is acting as the internal bank, funding the growth of its two biggest, most capital-intensive unlisted ventures.
Precisely.
What's the risk here for the holding's investors? If Metamobilite or Alte Energy stumble, if their projects get delayed, if the market doesn't develop as hoped, the holding is on the hook for over 1 billion lira.
That's the core vulnerability, yes. The report doesn't detail specific collateral securing these intercompany loans, so the primary safeguard is the holdings control. They sit on the boards, they have full visibility. But for you, the external investor, the risk is plain. The repayment of that 790 million TL from Metamobilite hinges entirely on Q-Charge successfully deploying that $7 million from TL, building out its network, potentially launching EES, and becoming profitable, likewise for Alte Energy's projects.
It's a bet on execution. Now, what about the other way around? Does the holding owe money to its subsidiaries? Related party payables, Borsslar.
Yes, that figure also went up. It stood at 752.3 million TL, up from 450 million TL, and this is almost entirely owed to Binbin, about 661 million TL of it.
Interesting. So the big, profitable listed subsidiary, Binbin, is actually a net creditor to the holding company.
It appears so, based on these balances, and the sheer volume of transactions flowing back and forth during the 9 months was huge as well. The report mentions 2.57 billion TL in sales to related parties and 1.8 billion TL in purchases from them.
What kind of transactions would those be?
Likely things like management fees charged by the holding to the subsidiaries, maybe software services provided by Algorithma to Binbin or Q-Charge, possibly shared services. It's typical for a holding structure.
But does it raise concerns?
The main concern is always ensuring these transactions happen at arm's length, meaning at fair market prices, as if they were dealing with an unrelated third party. This prevents value being arbitrarily shifted around the group to make one entity look better at the expense of another. Transparency here is key.
So, wrapping up the balance sheet risks. Strong equity, good cash, but a massive concentration of credit risk tied to the future success of Metamobilite and Alte Energy repaying over 1 billion lira they owe the parent.
That's the perfect summary. The financial health is robust on the surface, but deeply intertwined with and dependent on the successful execution of its key unlisted growth assets.
Okay, we have navigated through inflation accounting, the huge capital changes, the portfolio pivots, the massive internal loans. Let's try and boil this all down. What are the absolute key takeaways for you, the individual investor, thinking about 1,000 Yatırımlar right now? Hashtag 5.1 operational summary and future outlook.
I think our deep dive really confirms 3 fundamental points about where they stood at the end of Q3 2025. First, their identity is crystal clear now. This is a pure investment holding company. That stunning 3.25 billion TL net profit, almost entirely driven by financial asset revaluation, mostly Binbin's rising stock price, not traditional sales revenue, Hasılat. You have to accept that's their business model.
Right. Point 1, they make money by owning appreciating assets.
Second, they pulled off a massive profitability reversal in 2025. Flipping from a nearly 2 billion lira loss to a 3.25 billion lira profit is huge. It shows that, at least during this period, management strategy for selecting assets and timing things like the Binbin IPO was highly effective, especially when you measure it in real terms after TMS 29.
Okay, point two. The strategy worked spectacularly in this reporting period.
And third, the portfolio isn't just growing, it's getting external validation, securing major partnerships like QCharge did with Trugo, and especially raising that $7 million in third-party capital from Tishel for Meta Mobilite. That's powerful external proof. It adds credibility to the value of their unlisted assets beyond just their internal models.
Got it. Point three. The portfolio is active and getting buy-in from others. Looking ahead then, what are the big things to watch?
Operationally, it's all about execution now, transitioning projects from paper to reality. Those big Alte Energy solar projects, the 14.9 millibdio ones in Antalya and Nevşehir targeting Q1 2026, hitting that deadline is critical. That's a major operational checkpoint.
And the newer ventures.
We absolutely have to remember those strategic pivots that broaden their horizons. Getting the e-money license for 1,000 Pay completely changes their potential in fintech, allowing deep integration across the group. And that surprising, pragmatic pivot by 4B Mühendislek into food wholesale with the 142 million TL buy-in. It shows management is opportunistic and focused on value, maybe more than just sticking rigidly to tech and energy. Hashtag 5.2 management insights and external factors.
Did management give any reassurance on stability or risks in the report?
They emphasize stability, yes. They state there are no significant pending lawsuits against the company. They also say they don't anticipate major regulatory changes that would seriously disrupt their operations. And as we discussed, the formal governance structure, the committees, seem robust on paper.
And summarizing the risks we've identified throughout this.
Liquidity risk looks low right now. Plenty of cash, positive operating cash flow, that's good. But the big one remains concentration risk. The holding is heavily reliant on Meta Mobilite and Alte Energy succeeding and being able to repay that billion-plus lira they owe. Investors absolutely need to keep a close eye on the execution milestones for those two subsidiaries. Their success is paramount.
Okay, and let's circle back one last time to inflation accounting. After drilling down this much, what's the final word for the investor on trusting these profit numbers?
The final word is that because they are inflation adjusted using TMS 29, the multi-billion lira profit figures are much more representative of the real increase in the underlying asset values than unadjusted numbers would be.
So more trustworthy.
More trustworthy in reflecting real value creation, yes. The volatility risk tied to asset valuation is still very high, of course. But the numbers themselves, post-TMS 29, give you a solid baseline that strips out the distortion of just nominal inflation. You can be more confident the reported appreciation reflects genuine growth, not just paper gains from rising prices overall. And, this really leads to an important question, maybe some homework for you, the listener, as you continue to track 1,000 Yatırımlar.
Oh.
Given that we've established their profitability is almost entirely tied to the perceived fair value increase of their subsidiaries, both listed like Binbin and unlisted like Meta and Alte, what non-financial metrics should you be watching most closely?
Like real-world performance indicators.
Exactly. Things like Binbin's actual market share gains year over year, not just its stock price. Or the speed at which QCharge is actually acquiring and activating new charging sites. Or the concrete progress Altai Energy makes in commissioning those big 14.9 MW solar farms. Which of those kinds of metrics will truly signal sustainable, long-term stability and growth over the next year beyond just the fluctuating financial valuations?
That's a great point. Connecting the financial story back to tangible, on-the-ground progress. That's the real challenge for the investor here. Well, thank you for joining us on this incredibly detailed deep dive into 1,000 Yatırımlar Holding 8. It was a complex one.
Yeah.
If you do need more details or want to ask the company directly, their investor relations email is yatırımçılıskilleri@1000.com.tr. As always, we encourage you to keep digging, keep researching, and stay informed. Until next time, we'll see you for the next deep dive.